All right, welcome everyone. This is Matt Snow live from the CBA conference here in DC with Mark and Melinda. Thank you both for joining me. Why don't we take a minute and introduce yourself, tell everyone kind of where you are today, a bit about your role and how you got to it.
Sure. So Melinda Zabritski, I'm with Experian Automotive and have been for 20 years. I do a lot of product development, product positioning, but probably the biggest role that I have is I host a quarterly industry presentation, State of the Automotive Finance Market, talking about the trends occurring in auto finance.
Great. I know that's something we look forward to seeing at Upstart as well. It's a really in-depth, great look at the industry, so appreciate you doing that.
Thank you.
Mark.
And Mark Pregman, General Manager at USAA Financial Savings Bank, and so I run consumer lending. So that's basically all of our lending products with the exception of real estate and credit cards. So think auto lending, unsecured personal loans, marine RV. Been there about 4 years, but in the industry over 30 plus years. Previous to that was with PNC Bank and Truist Bank. So, but auto finance my whole career.
And a returning podcast guest, an
That's
early
right.
early guest with Jeff.
During the pandemic.
Oh, right.
Yeah,
So it's good to be doing this in person then.
Exactly.
And I know, one of Jeff's things was to ask a few questions at the end, and one was to ask for a bold prediction. I don't know if you remember yours. I went back to your episode today.
I do not remember. What did I say?
So your bold prediction was that banks would still be around, and I know, between now and then, we've had some banks fail, but It seems like they're still around. You stick with that prediction?
Yeah, I do. I think banks generally are healthy. I think everybody's going through the stress test again now, but I think you'll see with the new CECL rules out there, with the way you have to reserve for loan losses and take care of those ups and downs you see because of the industry or just because of what's going on with the economy. I think banks are in a much stronger position now. Underwriting standards, because I've been consumer credit, I think are much stronger, especially real estate. Because I've done real estate underwriting before. I don't do that here at USA, but I think to qualify for loans now, there's the asset test. I think is much better, and collateral values are coming. I mean, I think collateral values are generally pretty strong.
Yeah. So much stronger from a credit perspective. How about deposits? I know getting deposits now is a pretty hot topic.
Yeah,
I feel like
that's not my forte, deposits, but I just being adjacent to it with my peer. I think banks are still pretty flush with deposits. I think the pandemic added to that with everybody on their balance sheets got strong because of all the stimulus, or didn't have to make your mortgage payment, your student loan payment. But I think the industry in general is starting to see drawdown in their savings, drawdown in their checking accounts. They just don't have that. I think mainly because it's going towards inflationary type items, just trying to keep the lifestyle that they have out there, whether it's travel, whether it's just food on the table. We're seeing just industry in general seeing a flight from deposits.
Yeah, and I know we'll dig into that much more, but Melinda, maybe you can give us a 30,000 foot view of the state of the industry. You had a really good session earlier today. What are some of the trends that have stuck out to you?
So there's, of course, affordability still remains, top of mind for most of the industry. Availability is getting better. Originations were a little suppressed. But what's been nice to see is over the past 6 months or so, 6 to 8 months, is the growth in loan amounts has slowed down. Average new loan amounts been hovering around 40,000. Used has come down a bit as well. Still high. But of course, the raising interest rates still continue to push those payments even higher. And then with those rates and now incentives coming back, there's been a lot of shifting in share as far as, who's doing the originating. I mean, captives started coming out with a lot of incentives towards the end of last year, and that shifted a lot of share back towards the captive way.
Yeah, I was really surprised with that. I mean, the market moving primer in general, but captives, more incentives. Is the rising price of cars helping them do that, or how is that coming in?
Really tied into the fact that there was inventory. Without any inventory, we really saw no incentives. That was, of course, the same time that the rates were going up. Credit unions being slow to raise their rates really took on share, became the largest lending segment, especially on used. But with days supply coming back, inventory back, we did start to see the incentives back in the industry, and that really just pushed the captive share.
Gotcha. And I know you had a stat, Mark, you talk about like inflation and the cost going up, not only for vehicles, but the total cost of ownership of a vehicle really adding burden to the consumer.
I was reading today just in CPI, we came out, auto insurance across the industry. This year over last year is up 20%. Just a little bit north of like 20.5 I saw. So when you look at the consumer, the average car payment with interest rates being up, we just looked at the average, the number one car finance is the F-150. And so that's pretty much, all banks are financing that. But you look at the average cost of last year versus today, with interest rates going up, cost to insure and gas, it's almost $240 a month difference between this time last year. It's huge. It's. I think what Melinda talked about, that's what's impacting, I think, affordability in general. I think that's also why the captives are out there subventing. I think If their cars weren't selling themselves like they were in the pandemic, I don't think they would do that. I think if interest rates were normal, they probably wouldn't have to do it either. Yeah.
And I think the last time I looked at the F-150, I think the average loan payment was around $1,200.
That's insane.
Well, I remember, you'd think a truck, I'm in and out for like $40,000. F-150, you're talking minimum 70.
Yeah.
I mean, yeah.
So are consumers making different choices given that burden? Are they choosing lower models? Are they changing the way they finance these cars?
It's funny because I've been doing this for a long time, and people would always ask, like, what's the consumer stressor? Will we see consumers, if they start getting stressed, going back into cars and like away from the big trucks and the SUVs? And that's just not the case. We're still, like I said, F-150, CRV, the SUVs, it's over 60% of what we finance are SUVs and CUVs. And they have price points higher than cars. Of course, we're also not making as many cars. But we're not seeing consumers, shy away from those vehicles. Leasing's coming back, so that's helping because that's bringing a lower payment. But consumer behavior hasn't changed. The most interesting shift in consumer behavior that I've seen in the data is with the raising interest rates is cash. We've seen a lot more cash come into the market. Mm-hmm. We used to do about 15% cash. We're now over 20 for new. Used is like over 70% cash or a little over 60% cash. So a lot more cash.
Yeah. So was that fueled, do you think, by the stimulus or what?
No, it was after that.
Okay.
I mean, it was really tied hand in hand with the raising interest rates.
Okay.
And if the captives weren't running incentives, if you didn't have that 0% or 1.9.
And I asked you the question in the seminar today, but basically asked is it home equity money coming to the table? And it's not. It's cash.
It's real cash.
It's
The
real
people
cash.
have that.
I can understand writing the check and going off the line as I get
Yeah.
the tax deductibility, and I can do it over maybe 20 years,
Yeah.
to get that payment down. But it's true cash, which is kind of surprised me. But I think that affordability is just a big issue. I think I looked at, they're going longer terms, but I do think some of the consumers out there just sit on the sidelines. I think that's why you see the subvention out there. Car dealers are coming off the price that they were MSRP only, so I think you're starting to see them come off the price before. And so, but I think it's just overall affordability. You said, what, 16% over $1,000?
Yeah, a little over.
I was like,
for new. Yeah.
that made my first house payment. I'm sure maybe it's less than $1,000,
Yeah.
but I can't even imagine a $1,000 car payment. And it's on the lower credit scores, is what you told me.
For new, I mean, new car buying is always going to be very prime.
Yeah.
But it's still a prime score, but it's one of the lower scores compared to like the 600 payments or the $400 payments. But yeah, it was one of the lower, and even on the used side, 4.5% over 1,000.
Yeah.
And they're those big trucks.
Well, and I think I saw a stat too for the banking, I did not include the caps, it's just banks and prime lenders out there. 30% of the market is terms greater than 72 months. 30%. And so, but the average the average term is still 68 on average, what you book on that on average, but 30%, I was shocked at that number too. That's across the industry. So I think consumers are just choosing those longer terms to get the payment down.
Just to get the payment down.
Yeah.
So other than extending term to get the payment down, are there other things you're seeing in terms of how people are financing these cars or innovations in the automotive, the dealer, the lending space to get?
This is pretty plain vanilla lending. I think we're seeing longer terms. There's nothing exotic out there.
Yeah.
I mean, banks used to do balloon lending a long time ago to kind of keep up with the leasing. I just don't. I think for auto lending, just to stick to the tried and true. I've not seen anything innovative out there. And the consumer, I think we're seeing put more money down. You just try to get that payment down as well. And then people hold on the sidelines, I think, too, as well. So you can't create demand. Yeah, you just can't.
Well, I think also one thing that really helped from a consumer standpoint was even though inventory was scarce, it drove up used values. And that led to, over the past couple of years, consumers having a lot more equity in their vehicle. I mean, you could look at the top 10 most commonly purchased used vehicles. And the trade-in values, or even just the retail value on those cars, were higher than the original MSRP from when they were bought 2 or 3 years ago. So that really helped, and so it's been beneficial for banks, but also beneficial for consumers in bringing those loan to values down quite a bit on used. Now we're still kind of seeing the opposite of that on the new vehicle side. It's getting better, but with the inventory scarcities and things selling well over MSRP, we saw those loan to values just really skyrocket. So we're kind of recovering from that. But it's still looking really good for the used market.
And I'll give you my personal experience. So my daughter went to school in DC. Her car got stolen when
no.
she was in grad school. So that's what I had to pay MSRP. I never paid MSRP in my life. So 2 years ago, I go to the car dealer, and they was like, "Hey, we got three Subarus coming in, meet or they're going to be gone." So we let the truck pulled up, cars got off. So her car got stolen. They recovered the car. I was like, "Oh, don't recover." And they did recover. The police found it, and it was a Toyota RAV4. We paid $21,000 for it. She went to school, and I think I'm going to get. It was a total loss claim. Okay, I said I'm going to get the value I got was $15,000, and the car was 5 years old.
Yeah.
And I was like, I paid 21 for it. So then the other shock I had was I go to the car dealer, like, while we're waiting for the semi truck to pull up with the cars on it, we're looking at used cars. And the price of the same car was more expensive than the new car. I was shocked.
Yeah. Definitely, those values were really surprising. I'm not the only one that during 2021 made money selling a car.
Yeah, right.
It was,
Which is not, that doesn't happen.
No,
you heard cases of people, especially with trucks, saying, "Hey, I made $15,000 on this truck."
Yeah.
It was crazy. But
So-
those days are gone.
Yeah, I was just so where do you see that end? Like, or are we in a new normal, or what? Where's the industry go from here?
Yeah, values are still a little inflated, and I don't expect that to. They're down.
but they're still high.
Yeah, they're still high. I don't expect that really to change because when you do look at the used car market, so much of the used car market is contingent upon off-lease vehicles. That constant supply of late model used vehicles coming back, and we're still doing strong on the returns from 3 years ago when we were leasing over 30%. But keep in mind, we've had a year and a half where leasing was under 20. So in the future, starting towards the end of this year and really into 2025, we're going to be down over 1 million units of off-lease vehicles that we were used to. So I think we've got the potential for that to impact values in the future. The off-lease is still doing well right now, but the reduction's coming.
Interesting. Have you seen any changes to underwriting in terms of, you said, like the lending side, usually tried and true?
Yeah, I will say this. I said for the indirect lenders out there, not for the direct lenders in general in the industry, we've seen a tightening in both pricing and also in credit policy. Especially when you come into a recession, you're going to see that. When you're a direct lender, it's a little bit different because it's a known customer, it's a known member for USAA, you know them, and they probably have another product or service with you. But when I'm buying paper from a car dealer, it's a brokered loan, so there's some risk, you carry higher risk because of that, because they don't see you as their primary bank, the consumer that gets the car loan. So there's a little bit more risk in this, but I think the indirect lenders and the large lenders have tightened up their buy box. I don't think it's been wholesale changes, but I think they've tightened it up. And then they've also priced up to take on, because they're looking for more risk down the road in losses or with the economy. Now I think we're coming to a soft landing. I don't know what you want to call this economy.
Yeah, right.
So it's just weird. So I do think you'll see it again. It will open back up, I think, again too. When it does, I don't know yet. Yeah.
What are you saying? Because you have access to a lot of data at Experian in terms of trends. What are other lenders doing? Do you see pockets of that loosening up?
Yeah, so I don't see it loosening per se. Credit scores continue to increase. Just overall consumer credit is increasing. More consumers are prime, scores are just rising. But when I look very specifically, like if I'm looking at like the top 10 banks, almost everybody year-over-year credit score increases. Fewer originations in subprime. And it's a bit of a mix because yes, there are fewer subprime consumers out there. But the reduction, especially in the bank population, is well beyond what just normal increased credit scores. So I definitely see the banks tightening up. Like I said, the loan to values for the banks on the used side has been really, really strong. It's like 90% rates versus well over 100. So I definitely see trends like that. And I think, a lot of also, there's been reduction in bank share, but so much of that was credit union driven and captive driven, and a few banks leaving. It'll be interesting to see as the market continues to rebound and when delinquencies start to come down, which are not coming down right now. It'll be interesting to see if those lenders come back to the market.
Yeah, so that was actually going to be my next question. Are you seeing the delinquencies kind of just return to a normal? So we're seeing that spike right now, but it's just kind of renormalizing?
For the most part, if you look across the various trade types that we're tracking delinquency, bank card and mortgage and, unsecured lending, et cetera, they're kind of returning to, pre-COVID levels, which was extremely suppressed. Yeah. So those are sort of returning to more, normal type levels. Auto is a little inflated right now. The auto delinquency numbers that I'm seeing are relatively high. Like the percentage of loans themselves are kind of similar to what the peak was in 2009. Okay. The balances are higher, but in part, we also have twice the amount of balances. 1.4 trillion in automotive loan balances. It was half of that in 2009. So of course it's going to be higher.
Gotcha. Might I ask a question?
Yeah, go right ahead.
I know the question I asked her, but I'm curious with the FICO scores going up. This is just in your experience, maybe the numbers won't show it, but as delinquencies are rising, charge-offs are rising, and revolving balances, debt's going up on revolvers, right? There's more. Do you think you'll see natural scores come down?
It's interesting because the score increase has been going on for years and years. It's not a relatively new phenomenon. Like I said, it's been like 6 points every year since 2013. We didn't see it come down when the delinquencies declined after 2009. So it's been kind of continuing to go up. I think the rate of acceleration will probably decrease because you also have to look at that whole, the aged mix of the consumer population. Exactly. Yeah. And people ask, well, how can scores go up and delinquency increase? It's like, well, the delinquency is increasing in the younger population, which is where the lower scores are. And your aging population has higher scores.
Yeah.
So that I agree with that. Then I'm curious what you think is. There's a lot of, I think consumers are more aware of their FICO score now. They're more aware. They can go to places and they can say, how do I improve my score? And I'm wondering if that's some of it too.
It is. We've done a lot of analysis around that because there's aging, but the awareness of consumer credit. I think every single credit card I have, probably USAA included,
thank you for your business.
gives me the opportunity to see my credit score. Yeah. Every single one. And we did a survey recently of consumers asking them, do you know your credit score? And universally, people were like, yes, I know my credit score. If they didn't know it exactly, they knew the rough range that their credit was in. It is an everyday discussion, which is like when I travel and people ask where I work, I'm very hesitant to sometimes say, because everyone wants to discuss, credit scores.
Yeah, and how can they improve their own credit score?
Exactly.
Yeah, give them advice.
But people are well aware.
It is crazy how that's changed even in my lifetime from the point where like you would only know maybe as you're going in to apply for credit or if you got the
mortgage especially, right?
Yeah.
And that's the only time you really would know. Never before you shop for a car.
No.
And so we're seeing consumers in general, not just our members, but they're like general population out there. But they're going to say, what's my score? Because I know it's tied to my rate.
Yeah.
And what can I do? And then you see, and there's some aggregators out there that are, and they're not banks, but there you go there and they'll help you figure out what you can do to get your score to get a better price. Or I have a loan, it's at this rate now, I had to get a higher rate because my credit score was good. What can I do? When can I refi to get it down so I can refi my rate down? So there's a lot of aggregators out there, they didn't exist before.
Yeah, well, like Experian Boost, use alternative data, boost your credit scores. Yeah, a lot more consumer education.
Yeah, exactly. I want to go back maybe a little bit, Mark, because I think you have, especially with the member base at USAA, a lot more connection to their stories and how they interact with the banking world. Are you hearing from them as delinquencies are going up, like why, because we're seeing primer consumers, again, delinquencies going up. Are there different reasons? Are they calling in looking for help? Or do you have any insights into why?
I think it's pretty much what my whole experience is. Mainly just there's some type of a hardship going on, loss of a job, but unemployment's still very good. So it's usually it's like, you had dual income coming in and then one lost their job, or hey, it's like between jobs and stuff, and it's a short-term kind of event. But there's nothing I think out there just like there's any new things that we're seeing out there. I think in the industry in general, so that's just regular. I think it's just normal. I think it's again affordability. Everything's expensive.
Yeah, right.
And so everything's more expensive now.
And I think that's what's also leading to us seeing delinquency occur in segments that traditionally don't account for the majority of delinquency. Yeah. Your lowest credit scoring consumers will of course represent the majority of delinquency. Scores work. But we're increasingly seeing that near prime consumer. And we're talking like consumer scores that are 600 to 660, that's kind of middle of the road. they're increasingly representing more of what's going delinquent. And that really started with COVID. Like you would see, near prime be 5% of delinquency accounts. And now it's like 12. So that's I think where we're starting to see that, and you're starting to see these consumers also use more alternative financing, or short-term loans, and hitting online kind of those online loan brokers and such.
And you would know more than I do. I read a stat that comes Wall Street Journal that was like 60% of consumers are paycheck to paycheck.
Yeah.
And if that's the case, and with inflation up, one paycheck missed, I mean, that's a big deal.
Yeah, no, we see lots of stats like that too. I think I've seen that same one, or the average household can absorb, maybe a $300 to $400
Something happens to
emergency.
the roof, they have to fix something, AC goes out. I mean, that's a big event, right?
Yeah.
You can't delay putting off the AC if you live in Texas in the summer, right? I mean, you can't do it. So,
Yeah, and you can't miss a car payment because you need your car to get to the job.
Yeah, and you probably have your job, right? But that's some life event, because things are. I mean, just look at the cost to repair a car, cost to fix your home.
Yeah.
I mean, I replaced my AC. It was almost 3x pre-COVID. I mean, it's crazy.
Come home from a business trip and your fully stocked refrigerator stop working.
Oh, no, yeah. Life is full of those. Yeah. So, we're day one, maybe more if you're involved in the CBA into the conference. What have you guys picked up so far? If you attended other sessions, anything that you're learning?
Yeah, I've mostly focused on the auto sessions, went to the EV session before ours. And then I've had meetings. So it's been catching up and just kind of getting more.
I've been on the auto too as well. I haven't had a chance to go out to that. One thing I just love, the CBA. This is one of the best events out there. I mean, no doubt. I think the other thing is that the energy here. I think you all like the folks here that are in the exhibit hall.
Yeah.
I think energy's up, and it's a tough year. I mean, for auto lending, but the energy's still up, which is good.
It is.
And for me, it just more confirms on we're not the only one. I mean, it is, and so it's like we're experiencing. Everybody's experiencing the same thing. So I think it's that whole general, just like you learn, that like it confirms more confirmation of things.
Yeah.
I don't think anything I've yet. We can still get the conference ahead of us. Nothing new, but some of your stats were today. But other than some of that, I mean, am I missing something?
Yeah.
I didn't think we're missing something big.
I read a stat last year that auto fraud, finance fraud, outpaced card and deposit fraud. That was I saw the industry stat, and so I'm seeing a lot of people talking about fraud here that it was always talked about.
Sure.
But I think because in auto lending, I'm hearing more of the auto lenders out there talk about fraud. So I think it's been increasing. So I think all those things, AI is probably behind on the fraudster side, right, to do those type of things. But I think that's one thing I haven't yet to go to that. But I'm hearing I'm more interested in attending the fraud sessions.
Yeah, a lot of focus on fraud.
Yeah, I think with any tool, like the bad guys tend to get a hold of them before the good guys. So it's good that we're able to have
And
some of
it's
this
not- I mean,
conversation.
The fraud, the industry, because there was an expert that was talking about it. I was at another conference, and the thing that shocked me was it's not the hacker in the basement; it's sovereign nation fraud. It's like
They're big rings.
Yeah,
It's big
it's
rings.
like
Yeah, auto's always a little different because it's not like credit card where you're worried about bust out fraud and all of that. It's that car's
Think
gone.
about it. I mean, what it makes sense. You think about it, but the reason why the fraudsters have moved on from credit card deposits is because I have to do $60,000. I do 60 accounts to take over $1,000 for a credit card. I do one auto loan, and it's I think the severity is higher, frequency is less. But if you can get 3 or 4 cars, I mean, you could be a couple $100,000, as a fraudster.
So you actually have some involvement with the CBA. I'm sure there's a reason you really enjoy this conference. Maybe you can talk a little bit about
Yeah, so I've
your
been
involvement.
involved with the CBA probably 30 plus years. I think I would not be where I'm at in my position today without the CBA. One is it's just the relationships you forge. You come to events like this, you get to know other lenders. The committees are very strong. I think the committees of the health, and then I think the other piece is I went to the graduate school, banking school.
Yeah.
So what I love about CBA is I send my teammates to that school because I learned so much from it. Because a lot of us as bankers, we're specialists, and what that school teaches you how to do is teach you how to run a bank. So when they're talking about balance sheet and you may be in lending and you don't know what deposits does, you learn what deposits, you learn what CECL means, you learn what makes a bank healthy. Because like a lot of us come up, I'm a collector, I'm an underwriter, I'm product manager, I'm in pricing.
Yeah.
You don't get that. You may get a little bit exposure across the bank, but it really gets you horizontally and grows you. And then what they do on, I think, for banks, the trade association piece of what they do on Capitol Hill for us. and all what they do to like help with the legislation to make sure it's crafted in a way, that makes sense.
Yeah.
Yeah.
Yeah, I know that those can also be sometimes touchy subjects, but what are you guys seeing in terms of maybe rate reductions, changes in legislation, anything you're watching out for?
Definitely waiting for rates to come down. It's not going to happen anytime soon.
Yeah.
I think to me one of the hot topics is really tied more to the election as far as what direction it's going to go and the impact that it could have on the electric vehicle market. That's something that there's a lot of speculation around. Goes one direction, EV gets pushed, it goes another direction, and EV is not going to be pushed. So I think there's a lot of speculation around that, and I think that's probably the biggest thing.
The Fed's they're signaling 3 rate decreases.
Yeah.
I think it's probably closer to 2, personal opinion.
Yeah.
I'm just my experience, but I think it will come down. But I think meaningful won't happen until next year.
Sure.
I think they're trying to balance out because employment's still strong, but it's inflation, right? They're trying to balance it out.
Yeah. So maybe dig in a little more about the EV. Like what changes do you think that would have further down market, depending on the?
Well, I think Toyota's already come out and talked about their push more towards just pure hybrid and more of the hybrid plug-ins, and I think that's probably more the direction. I think we'll start to see less emphasis on EV. And also, will there be the infrastructure, the dollar spent on the infrastructure to truly support where 30-40% EV rates are supposed to be?
Yeah.
And of course, for me, I look at the EV market. I'm a little mixed on the EV market, in part because I think yes, increased fuel economy always extremely beneficial, but you also have to consider today's new car becomes tomorrow's used car. And your subprime borrower is looking for cars and looking for affordability. And yes, more inventory, prices will come down, but you're still looking at a vehicle that is going to cost more, at least initially up front. So, we've got a large subprime population out there. What are they going to be buying?
I think it correlates too with gas prices, right? So, you do the math, how much more I pay on that versus if gas is, moderate, not way up there. You're paying European rates, that's a different story, right?
Sure.
But I think you do the math and it takes a while to get paid back. And I think it cooled off a little bit too, is the same fears. There are a lot of incentives out there to do it, but I think also too is that it's that fear, how long is that car gonna go? The charging's a pain in the rear. It's like and those are legit. If it's just your commuter car, but to be your primary car, most people I know, if it's their primary, they're just going back and forth to work, maybe the grocery store, but not like, because a long distance trip, you got to think about it. People do it. Other people do it, but I think for consumers as a whole to embrace it, there's still some things that are holding them back. But the thing I remember was like, okay, so when the United States went from horse and buggy to automobile, the government didn't force them to go into an automobile, right? It had to make economical sense. It was a better product.
Yeah.
I get there faster. It was, whatever the cost to maintain, whatever those things were, is what drove that consumer to adopt getting out of the horse and buggy. Yeah. I think it's the same thing here.
Yeah, we were running some numbers on it. If you think about it, there's 288 million vehicles on the road, light duty, not even including medium heavy, and just in the U.S. And it's only about 1.78% of households have an electric vehicle, and 1.5 have an electric vehicle and another fuel type. So to the point of it's not
I
necessarily
think
the
the true
only car.
hybrid the true plug-in hybrid, but they're expensive and there's not that many out there. Like when you wanted to get that electric car EV years ago, it was just that you had the Prius, but it was Spartan. It's like now then other ones came out. They're more luxury now and everything else. But I do think the true plug-in hybrid. I think that's where it might go there first. That'd be a much better adoption there. But the prices are expensive too.
They are, and you're right. There's not that many of them.
Yeah, and so those
There's
things
not
combined.
that many. There's like very few.
Those don't seem to relieve some of the pressures we were talking about earlier on the consumer.
But those ones too electric that are true hybrid, they don't have the distance of a true EV.
So it's like that. Maybe I've seen 60 miles at most. That's my memories. It could be wrong, but I think it's not like 300 miles I can get with a Tesla or whatever else. So I think that's. But the true hybrid, if they get longer distance and you have that gas, you don't have to worry about that. If I'm going cross country, going long distance, I have to worry about charging. Yeah,
and I don't remember the numbers, but I saw somebody presented at another conference recently. They were showing, I think it was Cox. They were showing the percentages, like the percentages of households that actually have a garage. So if you are doing home charging, do you have a driveway? Do you have a garage? Do you have a place to park to actually charge your vehicle? And I was surprised at some of the very low figures. And I just look at my neighborhood. Of course, I'm also in a snow state, so I have Colorado, ice, snow, etc. But I look at the fact of, I think I am the only person in my entire neighborhood that parks their car in the garage. Everyone else at storage. But my house is also 120 years old. I can't accommodate an electric vehicle.
Right.
I can't charge it.
I think they're cool. I like them.
It's neat.
I'm sitting on the sideline right now, but I like it. I like to think about it, but it'd have to be my third car.
Yeah.
And I just like that. The other thing I read, it was I forgot where it was, but it was about apartment complexes. How many they're in apartment complexes, and then the apartment complex, the large communities, the ones that like the post homes and stuff like that. The cost to put a charger in an apartment complex, and it's like they're expensive. And then even if they charged somebody to charge their car, the payback was a long time. So I think look how many people are in apartments.
Yeah.
You got to think through those things. Yeah.
Is there anything that those OEMs are doing differently to disrupt the buying process, the financing experience with the consumer?
From an EV standpoint?
Yeah.
Nothing that I've really seen. I think, outside of the captive, I still hear some lenders talk about just some uncertainty with financing, EVs. I think there's always that speculation around battery fear, which I think is for the most part unfounded. You do see instances where you've got lenders who are doing products where there's an additional insurance on the battery as part of, as part of the financing. So you do see things like that. But overall, I don't really see that much of a difference when it comes to the EV space versus traditional.
Yeah, I haven't either. I think the thing, the real legit is that it cost to. We talk about the cost to insure an F-150. The cost to insure an EV is up there too. It's higher. I mean, it's a higher premium. That's why Tesla offers insurance but then you're going to wonder, that's now, but later when they have loss rates down the road, is it going to change? I don't know. So that's still uncertainty out there. But I think that having to get that insurance in there is, I think, what the automakers are doing. Nothing that I think the lenders I've seen out there are doing.
Yeah, I've heard mixed on that, where they are cheaper to maintain. There's fewer mechanical parts, but in terms of repair, they seem to be much more expensive.
If you get a stamped car, you get in an accident, you're not just taking off the bumper. Yeah. It's the whole front of the car, right? Or it's the battery on top of it, right? So it's more expensive to repair.
Great. Well, I appreciate you guys joining me today. Any other thoughts you want to leave us with?
I'm looking, rates come down, please.
Yeah. I think that's probably unanimous sentiment at the conference.
But no, I mean, I'm just seeing a lot of positivity in the data. Like I said, the loan amounts are stabilizing. We're still growing. Consumers are out there buying. We're financing. It's still plugging away.
Great.
I think for banks, for prime auto finance lenders, been through cycles before in my career. I think this is going to be a tough year. Yeah. There's more headwinds. We talked about it today in our conference this morning. But I said more headwinds than tailwinds. But I do see green shoots for next year with rates coming down, inflation coming down. But I think delinquencies will come down too as well. I think as inflation starts to come down, I think things will improve out there. I do feel, and there'll be pent up demand. So I think for those lenders out there, because people have a love affair with cars. And I think they're on the sidelines now, but when those things kind of return, they feel more comfortable. I think for lenders, next year will be a better year.
Great. Melinda, Mark, thank you both for joining me.
Yeah.